Hello, welcome back to Retirement Clarity Radio. I am your host, Scott Newhouse. I'm so glad that you're with me. I am in an especially good mood this week. My football team, the USC Trojans, also my alma mater, we got rid of our lousy, mediocre, in-over-his-head football coach, Clay Helton. Goodbye, Clay. Good riddance. And I am so excited to see USC football redeem itself and get back to the powerhouse that it was before. So if you hear me in a perky, excited mood, that's why. I'm also excited to talk about what we're going to talk about today, which is how to protect your retirement from inflation. So last week we went over what is inflation, why is it so high right now, and what are the pernicious, harmful effects that it could have on our retirement. So if you missed that episode, go back a week and make sure you listen to that one. This week, though, we're going to talk about 4 practical strategies that you and your family can implement to protect yourself so that inflation doesn't have too negative of an impact on your retirement. As I said last week, I'm going to keep on saying whenever I talk about inflation, inflation is often underestimated when it comes to your retirement. And so that's why we're going to talk about those 4 practical strategies you can implement to make sure you have a comfortable retirement for 3+ decades without having to cut back your expenses in any significant way later on in your life. So with that said, let's get into the first potential strategy that I have for us. And it's something that we've actually talked about before, but it's considered delaying Social Security. Now, if you have enough money to live off of before claiming Social Security, this is potentially a great idea. For many people, most people, Social Security grows around 8% per year that you delay taking it from age 62 to age 70. So again, it grows 8% per year that you delay taking it. In addition to that, Social Security provides an inflation adjustment every year so that your Social Security benefits keep up with inflation. And it's not exact in terms of inflation, but they do give you that living adjustment every year, and that really does help. So in 2022, the projected inflation adjustment is set to be around 6.1%. Yes, you heard that right. The Social Security inflation adjustment is set to be around 6.1%. Now, most years it isn't nearly that high, but again, as we talked about last week, since inflation has been so high so far in 2021, the Social Security Office is giving that boost to the benefits and to the recipients of Social Security. So regardless, if you can delay your Social Security benefits, they will almost certainly increase above whatever the inflation rate is that year. And that's mainly because of that 8% per year benefit that you get by delaying it, but you're also, again, going to get that benefit adjustment for inflation. So that's our first best strategy to outpace inflation, is delaying your Social Security benefits. The second strategy I have is to beware of and honestly limit or eliminate your exposure to low yield investments. And I'm mainly thinking about things like annuities and CDs, certificates of deposits. Now, some retirees worry that their biggest risk in retirement is losing principal. I actually disagree with that wholeheartedly. Your biggest risk in retirement, in my mind, is that your purchasing power gets eroded each and every year, so that when you're 15 or 20 years into your retirement, you cannot buy enough of the things that you need with the money that you have, even though you were able to do this in the first couple years or maybe the first decade of your retirement. And so that's my biggest concern about your retirement. Your purchasing power goes down over time, not whether you dip into principal. And so when you invest in low yield investments like annuities, CDs, and other types of investments like that, they either don't adjust for inflation at all, then that's a lot of annuities, or they offer a yield so low that the inflation rate that we experience outpaces the yield that your investment gets, and that's honestly most CDs. So I would be very, very, very skeptical, and if you can, I would think about not even having annuities or CDs in your investment arsenal. So that's my second practical strategy that you can think about when it comes to your retirement. The third one I have is to keep a heavy allocation of stocks compared to bonds in your investment portfolio. Now, it is hard, or frankly impossible, for me to tell you how to allocate your investments in terms of stocks versus bonds via this episode format that we have. What I can say, though, is that the higher percentage of stocks you have compared to bonds will, in the long term, be beneficial to you in helping outpace inflation. At least historically, that has been the case. And the reason why that that is the case is simple. Over time, stocks have historically outpaced bonds and by a quite big margin. So let me run some stats for you. I know it's a little hard to hear via audio to keep in mind all these numbers, but let's give it a shot. So from 1926 until the end of 2018, so almost 100 years there, large and small stocks have earned a return of around 10% up to 11.8%. And small company stocks got that 11.8% return. Large size stocks got that 10% return. Now, in that same period, bonds and treasury bills, which are, another form of debt, earned 5.5% and 3.3%. And lastly, last stat on this, over that same time period, almost 100 years, inflation was 2.9%. So again, let me run through those numbers because I know that's a lot. Large and small company stocks got between 10 and 11.8%, and bonds and treasury bills got between 5.5 and 3.3%, all the while inflation was 2.9%, so just a hair under 3%. So in other terms, stocks are able to outpace inflation by over 3 times, while bonds and bills didn't come close to outpacing inflation by that same rate. And over the 3+ decades that you're going to have in retirement, what you really need to do is make sure that your investments outpace inflation enough to make up for the distributions that you will be taking from your portfolio. Because you not only have to worry about inflation, which is a hidden cost that you're addressing right now on this podcast, you also have to worry about the distributions that you're going to be taking out from your investments, which we covered in previous episodes of this podcast. So go search back a few episodes and you'll find that as well. So those two things that you have to worry about basically means that if you have too high a percentage of your bonds, bills, low yield investments in your portfolio, you run the risk of cutting into your purchasing power later in life in your 70s, 80s, and 90s, which again, I think is the biggest risk, quote unquote, risk to your retirement and making sure that you have the lifestyle that you want for the duration of your retirement. Now, my fourth practical tip I have is maybe a little counterintuitive, but it is do not buy gold. And yes, you have probably heard somewhere that gold is a great hedge against inflation. Well, I'm calling a little BS on that claim. Long term, it's actually a really terrible hedge. And I have to say, I am a long-term investor. And when I say long-term, I mean I'm investing with at least a 10-year time horizon, up to 50 years and beyond in mind. So before you think, though, that, hey, Scott, that's too long of a time horizon for me, let me remind you that if you start your retirement in your 60s, there's a pretty decent chance that either you or maybe your spouse is going to be alive in your 90s. So I think everyone has the opportunity to be a long-term investor like I am. And again, well, not again, but if you think you can predict and profit off short-term changes in the market and the economy, I think all the evidence suggests that you're not going to be able to. So I don't think you should be a short-term trader, and I think you should be a long-term investor, and there's a big difference there. And in terms of the long-term, gold really doesn't hold up compared to the other investment alternatives that we have. So let's just talk about long-term results of gold. In the year 1980, at the peak of our country's only real brush with hyperinflation, at the end of the year, gold sold for $589.50 per ounce. And the Dow Jones, which is a major U.S. benchmark for stocks, it sold for $963.99. So again, end of 1980, hyperinflation, gold selling for just under $590 an ounce, and the Dow Jones, a big U.S. index, is selling for $963 a share. So today, and I just checked these numbers this morning, gold is selling for $1,761, while the Dow Jones is selling for around $34,000. That means that gold has grown its value by 3 times, which, is frankly not very impressive over a 40-year time horizon, while the Dow Jones has grown its value by over 35 times, which is much, much, much more impressive. So frankly, I don't think more needs to be said about gold as a long-term hedge against inflation or as an overall investment opportunity. I think it's a really poor one, and I think you should, avoid it. Now, some of you may be saying, and hopefully it's not a lot of you, but maybe some of you are saying, well, Scott, what about this last year? I bet gold's done well with the inflation that we've seen. Unfortunately, that has not been the case. So let's look at a gold index fund, and it's GLD, so you can search for that if you want. GLD, that's the index gold fund that we're looking at, created by State Street. They're an investment company firm. So year to date, from January to September of 2021, that fund's down 9.68%, even though inflation's up. So again, this fund's down year to date 9.68%. And over the last 12 months, the fund's actually down 8.27%. So over the last 12 months, which we've seen inflation anywhere from 4.5 to 5 to 5.5%, the gold index fund, which some people say is a great hedge against inflation, is actually down, and it's almost down double digits. It's down 8.27%. So, boy, I really don't think gold's a great long-term investment, and clearly it has not been a good short-term investment. So if you're thinking about using gold to kind of beat inflation, I really, really hope that you reconsider that investment strategy. So we've covered a lot today. We've covered 4 really important things for you to do or not to do if you want to make sure that your investments are properly structured against inflation. To recap really quickly, first, think about delaying your Social Security benefits. Second, limit or eliminate the money you have in really low yield investments like CDs or annuities. Oh, and by the way, your emergency fund does not count. I want you to have an emergency fund. So don't think about low yield investments as your emergency fund, because that's just savings. It's not an investment. Okay. Third point I want to make is that I want you to keep a heavy allocation of your money in stocks as compared to bonds. And then fourth, do not buy gold despite what the late night infomercials tell you to do. If you do those 4 things, you'll be putting your investments in a place where inflation won't have as harmful of an effect on your lifestyle, so that as you age, your lifestyle and your spending power will be able to grow as well. If you would like to help make sure that your investments are properly structured, I'd be happy to chat with you and even create a free 1-page financial plan for you to ensure that you can have a comfortable retirement. You just need to go to startmyretirement.us, and then you can find us a time to meet there. So that's all I've got for this week. I hope you enjoyed it, and I hope you have a great week. Bye.
Thanks again for listening. As a reminder, you should consult with a financial advisor familiar with the specific circumstances of your unique financial situation before making any financial decisions. Nothing in this podcast is a solicitation for the sale or purchase of any securities. Any mentions of rate of return are hypothetical in nature and not a guarantee of future returns. Scott Newhouse, CFP, is an investment advisor representative of Forthright Finances, a California and Nevada registered investment advisor.